welcome back to another live stream. So, hope you guys had a great week. We're going to be talking about all the topics listed in the title and or description below, so you guys can check that out. That will be our guiding playbook. When JC messaged me something about a song he wants me to play. I think the Money Baby song from that one guy. He's like, you forgot to play that. I'm like, yeah, good evening. All right, good evening. All right, so we're going to get started here on the 5-minute mark. So we have 30 seconds to kind of rest a little bit, take a deep breath before topic number one shows up. But topic number one is funny. We're watching the world, just like kill themselves with narratives.
This is very true. I mean,
so 7 seconds, 5 seconds, 4 seconds. You're gonna go ahead and start.
No, I was just gonna say. I mean, it's one of those things where if you look at the index, I actually find this is a funny thing, by the way. When markets are going up, a lot of people are long beta, and they're like, "Dude, look, I'm such a good stock picker. Look how much I'm going up. I'm beating the index." And then when like beta and momentum dies, people are like, "Yeah, I mean, the index is like not that bad, but dude, underneath, like the index is broken." It's like, well, you can't be a good stock picker when you're beating the index, and then when you're losing to it, the index is broken. Because the reality is, I mean, there has been like, what is it, like a 4% pullback, something like that, maybe?
Well, as of today, not anymore, but it was getting there.
Yeah, so it's like relatively nothing. Yeah, so I mean, markets freaking out over consumer government shutdown. What is it?
Well, let's start, I guess, with the consumer narrative, because that one's so funny. And we can maybe name a name of someone on Twitter who, I feel like is probably among the most retarded people I've seen in a very long time. And I find them more and more entertaining now that you've introduced me to them. And they were featured on Steve Eisman's podcast. So yes, I'm talking about that person. I mean, we're going to mostly be talking about that person when it comes to private equity and their takes. They really want, a financial crisis 2.0 so they can have a movie written about them.
Mm-hmm.
But they're just like awful takes, hilarious takes. But we'll get to that because we can also talk about her commentary on the BNPL segment.
Oh,
and how we can deconstruct it one by one. But let's first start with the narrative around unemployment. So when I look on, X or wherever, I'm starting to see more and more comments on unemployment, the labor market data, things being pretty weak out there, etc. And then I hear it, of course, from people like, the classical Stephen Van Meter, people with like fire in the background all the time, doomerism. And then you also hear it from the people who jump on hype trains, like Meet Kevin, etc., who has millions of followers. You also see it on, CNBC. The talking heads are talking to you about it, freaking you out. And then we listen to company earnings calls and, we hear a completely different story. And from the survey that everyone's citing from Thursday, one of our club members, because I'll give you a shout out, John. I mean, because credit to you, you found it first. So from the same report, the exact same report, Andrew, what did they find?
So the report was the report that we're referencing is the one, like you said, that was talking about the job cuts in October being the highest ever. And what he found was there was also within that report, companies announced their highest intention of their highest intent plans to hire in October. I think it was like the highest, because it wasn't like hiring in October. It's the plans to hire that they have in October. It's kind of like an indicator of forward hiring, but it's the highest it's been in a decade. Trying to find the actual numbers, But
Hey, real quick on Agamemnon's comment, that's not true at all.
what is it?
They would love to blame the consumer and the consumer being weak on a lot of things. They do it quite often.
Oh, companies. Okay. Yeah. So let me find it. Yeah. I mean, as an example, well, okay. To his point, there is a company that I follow that did say there was a weak consumer.
No, but he's saying that if they were weak, they wouldn't tell us they're weak. But a lot of times there's companies that will shift the blame from performance, operational performance, and say, macro,
That's very
tariffs,
common.
weak consumer. It's super common.
Yeah. Several companies that I short, because they're usually worse operators, said like it's an uncertain macro environment.
Yeah, usually it's like companies exactly you'd want to be shorting.
Yeah, so like for example, this one company that I'm short on said the third quarter revenue fell well below internal expectations due to continuing market headwinds, the consumer, ongoing production delays, and unforeseen shipping disruptions. So they usually blame external things. You don't want to say, yeah, the quarter was bad because we suck.
Yeah, I don't think Agamemnon's heard a Dollar General earnings call before in like the past 4 years or so.
Yeah.
Because they rely on the consumer. Because I'm just going off of your point, because you said, funny enough, if there is a company that depends on consumers, Dollar General, why on earth would they say their demand is weak? Dollar General did.
So I don't want to get like too sidetracked from the actual thing. Like we can debate.
Let's get.
But yeah, so basically within that report, so it's really interesting because that you see all the market headlines. First of all, we didn't talk about the ADP report.
Nope.
So the ADP report. So the ADP report. Let me see if I can just pull. So the ADP report came out, and it was, I guess you would call it a beat, would be the word. So within the ADP report, and I think it's a net job ad report.
Yeah.
They reported change in U.S. private employment of 42,000 jobs. The consensus was 22,000. So they beat by 20,000. So that was good. It's a positive indicator of like employment's good. So positive. I mean, nothing to say about that. But no one cares about that. What people focus on was and also one thing I found interesting about that, and they don't break down the segments that much, but the number one added segment was trade, transportation, and utilities. So it's like kind of in my mind, not how do I say this? Like the narrative that the economy is dying and everything, I don't think trade, transportation, utilities be going up if that's the case, but it could be.
Mm-hmm.
Anyways, that came out. No one really reacts to it. Whatever this company is, I've never even heard of them. I'm not saying that they're a small company, but like it wasn't something that's ever been in focus before that I've really noticed. Came out and said like job cuts are really high. That was like what everyone was putting everywhere. But within, like you said, within that same report, the companies reported the highest in a decade intent to hire in October. So it's like, that's just.
And that was from the same data source that everyone's using.
Yeah, so it was within the same report.
Yeah.
So it's one of those things you look at it and you say, it's really interesting. I listen to Howard Marks, The Memo, a lot, and he said something that I think is very true right now. It's true in general, but like you can see it right now. And he says, financial markets get hyperfixated on one narrative at a time. Mm-hmm. And then the narrative will go away and they'll get hyperfixated on another. So the hyperfixation right now is unemployment, consumer weak. And it's coming from even the origination, I think, of this like concern was from an out of context Jamie Dimon quote about cockroaches. Like that's where this all started. It was the first brands issue. Jamie Dimon said cockroaches. I was listening to the earnings call live. Jamie Dimon is a very pessimistic. Usually, it's like Monahan's positive on the earnings calls. Dimon's usually pretty pessimistic. I think City's kind of like whatever. And so, anyways, and then I don't really know about what's the Wells Fargo CEO. I should know this because I work there.
Sharf.
But Sharf, I was going to say, yeah. I just think they've been so focused on fixing Wells Fargo, I haven't gotten a good feel. But anyways, he was like, everything looks really good. And he was basically saying, there's some, like, on the first brands, when there's one cockroach, there's usually others. And Howard Marks actually talked about that. And he said, basically, the reason you see these clusters is there's a breakdown in underwriting because the credit markets have been good for so long. You get lazy in your underwriting. Not everyone does, but some firms do. Or you could say they get more risk on. And then once one gets uncovered, it kind of starts a domino effect of review and other ones get uncovered. So it makes sense that there's kind of little, that they happen in tandem. But yeah, I'm just reading comments here. They're very bearish. This is very good. This is very good. So that's just like kind of my, you listen to these things. The Jamie Dimon quote, like, for everyone here, did you actually listen to the earnings call and hear what Jamie Dimon and them said? So it was, I don't know, I think the whole narrative from the onset was misunderstood. Do I think that this is the strongest consumer we've ever seen? No. Do I think the government shutdown, the fears over the car market or the auto loans and the job market is driving some things, and there may be some things somewhat real in there? Maybe. But do I think it's like hugely problematic? No. And I think the most important for me as a stock picker is like, you look at the companies you own, and you're just like, they're too cheap. Like, okay, like, yeah, sure, the market could go down, but like, this stock that I'm bullish on is growing earnings at like 50% year on year and trading at a 14 PE. Do I really care? Like, okay. And you could say the E is wrong. I'm pretty sure it's not in my model, but so that's when I started to say, okay, well, I'm pretty bullish because everything I'm bullish on looks good. All the macro commentary from banks looks good. Why would I be bearish? But people get hyper fixated, fear sells, and that's what happens.
Yeah, no, completely agree. And like there's different things people are pointing to, but if like we break it down, these narratives persist, and usually when something bad is going to happen or turn over, it's when no one thinks something is bad and going to turn over. I think I reckon our weekly call we did in February, remember the short high beta title, right? Because we saw basically like insurance was extremely cheap. You looked around, and when I say insurance, for anyone listening, it's not insurance companies, but insurance as in for your portfolio for stocks for shorting. Is extremely cheap, and the put call ratio was extremely favorable to puts at the time. So that was probably your Goldilocks moment where every buyer was in the market. Turns out that was like February, I think, was like every buyer was in the market, and then we just broke down from there, and then of course April happened, and then we had a reversal of that where there's continuously a new buyer because I believe I shared this on Twitter. If I'm not, I'll bring up the image. But let me make sure because I might. Oh no, that's right. I didn't share it on Twitter yet. So what I'll have to do is I'll have to send it to Andrew and then kind of bring this up, or I'll post it in here and I'll bring this up. But for fund managers, Actually, maybe I'll leave this. I won't use this image because some people might get riled up. You know,
Yeah, I
because
don't
people
know
are
if I
emotional.
could have done that.
I'll keep it out because people get riled up, and it's not going to be productive to rile people up. So, no. Long story short, I think fund managers tend to be think a certain way, and that does end up skewing a huge let's call observation of the plethora of them being offsides. That's the words I used to describe it, being offsides. And so, of course, by the very nature of the competitive markets, right, most managers are going to be offsides at any given point in time. And in this case, there was an extreme offsides event, which is why we saw the violent reaction to the upside, because you got to think of it also in this way. So a fund manager, you're supposed to invest your clients' capital. Your LPs are going to also be, a little bit pressury on you if you got scared and you sold things and then the market recovers and you're still not in. That's going to end up more than often than not become a problem in that relationship. It's going to put strain on that. And so you had this capital sitting on the sidelines that needed to still be deployed. And even to this day, there's still a bit more of a bearish tilt. And more often than not, again, the plurality are not typically positioned properly. Most of the time, most are offsides. And a lot of what's, this can manifest itself. You can call it whatever you want, hated rally, etc. There's truth to it. While I disagree sometimes with the person who coins that term, and I used him as an example of April being, like the bottom was when he apologized. If you guys don't know who I'm talking about Tom Lee.
Does he call this a hated rally?
Yes.
Okay.
He's, I guess, the most famous, calling this the most hated rally, which I agree with him. But I also want to point out, because I have it screenshotted on my Twitter and it's pinned. It's like he did apologize. He put out an apology on the bottom. We also had, of course, like the Kramer Black Monday comment, but that was your bottom when the perma bull apologizes for being bullish. It was pretty funny. Come on. Like the perma bull of the market. It was like, I'm so sorry.
Yeah, he had to apologize. And that's when you're like, to be fair, like, yeah, I mean, he's like, because he made a call that like the tariffs are going to be less than what people think. They weren't. They were quite more. So
Alaka's making a good point, by the way, on the, if they tell you something again and again and again, they show you again and again and again, what would it take for the narrative to be dispelled? Which is fine, because that's the part that we have fun with, is because that provides the opportunity, because that means there's a marginal buyer. Right. I'm not saying that the Agamemnon is the marginal buyer, but it means that within the market there's a marginal buyer, and that's usually the misprice of the equity, right? So because there is a perception that is untrue, that then is eventually continuously proven true, or proven to be not true, and then you get that repricing of the equity. Because like when we get back to consumer, right, each of the companies that you would care about the most on commentary around consumer, which I get like the argumentation, and funny that Dollar General is being called a Kobe Riley stock. I saw that too. It's like I wouldn't call them that. And then yeah, exactly, B Riley stock is very interesting. Dollar Tree, similar steel, but I guess also B Riley stock. And Walmart, another B Riley stock. All having the same commentary. But for the case of Walmart, it's because like for at least like the headwinds that they experienced, they've been saying consumers been weak for gosh, how many years? I think in 2023 I was covering their earnings calls and coming on here and talking about how they were saying this, and I was hearing different things from others, and it's like, so the consumer, I guess, has been in a very weak for years.
Well,
but yeah,
I think doing great. You could argue there's been like a rolling recession within different industries.
Yes, which we'll talk about.
Yeah, there's a lot of things you could look at. Consumer being weak. I think that narrative is taking hold because everyone's worried about AI taking everyone's jobs, which is kind of silly at this point. because there's like been no AI related layoffs really. You can say the Mag 7, but those are over hiring layoffs, not, in my opinion, not AI related. Well, it's AI related, so they can get more capex, but
Yeah. But the rolling recession argument, like that truly is like what we think we're observing. And you're seeing that trough in trucking right now. So from the various sources that we have, who we've spoken to, they're telling us that things are looking more optimistic for some companies. And then we're hearing it now in earnings calls. We're starting to hear it now roll through, because if you go and pick a random stock, the the positioning of each firm in LTL, et cetera, they've been saying for, I guess, like you literally going back since like 2022, that we've been in a recession. But the thing is, of their sector. Now, I push back on that when I listen to that, and I'm like, that's an excuse, right? But it's an excuse because what they should be saying is like, look at the growth we experienced in 2021. We're just normalizing, because there was an extreme event that pulled forward so much demand. And it's not that the LTL industry is experiencing a recession. It's like, if your new standard is what you were doing in 2021, sure, but you've grown still since 2019.
yeah,
It's like you're doing fine, really. You just went through a crazy phase, and you're coming off of that, and then now you're troughed, and you're coming back up from that. So,
do you remember? This is funny. In April, there was like 1 or 2 days on FinTwit. Everyone was talking about the Zwig breadth thrust. Do you remember that?
the what again?
It was like Zwig or Zweig breadth thrust.
Oh,
Do you remember this?
yeah.
And funnily enough, one of the things is the funny thing is, I was like memeing on it time, because I normally meme on like any of these things, because it's like it's hard for me to just look and be like, oh yeah, here's like a random set of data that coincides with things that happened before, because there could be extra data that throws things off. So you just got to analyze what's in front of you. But it's been right. Everything that the guy said like would happen, and one of the things they said was there's never been a recession like a year to 18 months out from a Zwig breadth thrust. Yeah, I don't know if it's Zwig or Zweig, but so we can't go into recession because we had a Zweig breadth thrust. So that's all you need to know.
I look at it another way. It's very difficult to go into recession when you have capital unlock from the banking sector coming online at some point in the near term, potentially. That's a lever to pull. Then you also have the massive investment. Like, of course, like I can probably say yes to that because of artificial intelligence or the investment in data centers, that has helped the U.S. economy tremendously. Absolutely.
No, just look at Berlin Gamer's comment.
Oh yeah. No. Exactly. We were talking about that for a while. In fact, to disclose it, I mean, at one point we were short Target, right? But we're no longer short Target.
No mas, correct.
So for this full disclosure, but for Target, Target is not a consumer is dead. Target sucks, right? Target is going through problems where they're not able to match competition. Now, here's some. We spoke to someone briefly who used to work there, and we got a description of how behind they are in just logistics compared to something like a Walmart, that they are, into the description of the person, more than a decade behind Walmart, it seems. And so that shows up in the efficiency of the company. So of course, structurally, you're disadvantaged to your competitors. Things are going to fall apart. When you had sorry, you go.
The other thing about Target, no, and you're right. The other thing about Target is just like they had this like niche for like Becky, and it felt like it kind of went away. Like for a long time, Becky was like Walmart's below me. I feel like that Walmart's kind of also revamped and like it's not seen as like quite as low quality. Whole Foods has come in and become like the new thing. There's Costco, Sam's Club, things like that.
I want to address the comment on housing because I find it interesting, because there's one key point, and this could be similar to the trucking businesses where they are citing a normality that is not normal, but you had one very big advantage if you were invested in housing for the past couple years. Of course, builders properly reflected that. And I think it's getting to a stabilized point where it makes more sense. But for the longest time, at least for the past few years or so, what has gone off a cliff that has helped these companies? And what might come back online, or what is starting to come back online?
It's gone off a cliff. Oh. Current home sales?
Exactly. So that was my concern on the valuations, going back a little bit on the home builders and supplementary businesses like Builders First Source. And we do know that there's a very sizable cohort of demand for transaction. Just when we saw what happened to the mortgage originators in that first part of this year, when rates went down just a little bit, and then we saw that volume spike, and suddenly people got really excited, but it was a fake out because it didn't last very long. Yeah. So we know the demand's there is the thing. That's what we know. So that's waiting. As far as like this dam that's holding it all behind. But it takes some time for consumers to have this like new reset of what's normal, because there's a lot of people, and this is, of course, has an effect where a friend, a friend of a friend, but people in your circle that have this like ultra low mortgage rate, so you're mentally blocked to want or to kind of say, oh, I'm going to wait, because let's say you're not someone who's investing in equities, and it's not like a necessity, like a dire necessity to move, which is not everyone, because if you have a dire necessity to move, you'll move if you can afford it. But coming back to it, it is a reset that has to happen. To pretend otherwise is you're kidding yourself. That doesn't actually have price anchoring among consumers isn't a thing. It very much is a thing. So that takes time to roll through the system, which I think we're at that point now. And so once we start see rates tick a little bit lower, which I think most of the mortgage originators know this and are preparing for this. If you actually look at what their balance sheet activity has been, a lot of that has been either deleveraging, or the ones that have already delevered, they're basically ready. They're shoring up more and more cash because they're ready for a sudden spike. They're trying to prepare for that moment. But that's been a big deal for new home sales, and will be a big deal for new home sales, because for the longest time, well, not the longest time, but for the past few years or so, there's been a strong advantage that they've had. And the ability for, when you're going to, let's say, you could buy down the rate, so to speak, you could be promotional about it, and then be very competitive versus an existing new home sale, financing term. So that's some of the advantages. And a lot of the home builders, were even addressing that. But I know that because I was talking to some vendors for some of the national home builders. I won't say which one, but one of the bigger ones. And they had like a national, let's say, how do you call this? Like not strategy or plan, but not command. The word's escaping me. They told all their managers to cut all vendor prices by 10%, regardless of vendor.
It would be demand to be.
Come on.
No, I'm
forgetting
blanking.
the word. I'm blanking the word too. Order. Let's call it order. Anyways. So.
I mean, yeah, I guess with the housing, that one's interesting. U.S. housing isn't as unaffordable as people think. Go to the rest of the
Yes.
world. You will appreciate the U.S. housing market more. Could we? We have more sellers than buyers now, which could impact home builders. So we have 500,000 more sellers than buyers at the moment, I think, in the housing market. So that could impact.
But that's a
builders.
national figure. That's not a because
Oh,
you got
for
it.
sure. Yeah.
Yeah,
I
geography
mean,
by geography.
yeah, it's not a national thing. And the other thing I know that this could be a national thing, although it's probably is that it's cheaper to rent than to own for the most part. Which usually isn't the case, I think. Or maybe it isn't really the case. I don't know, but I don't know. When it comes to housing, if I like pull up like the Fred chart, looks fine. Looks like somewhat normalizing back to like 2017. Like it looks like it's normalizing back down slowly to like 2017, 2018 levels. Wouldn't be surprised for that to like you said, accelerate as current homes unlock, as people who feel like locked into their 2.5% mortgage say, okay, I can do a 5%. I can't do a 7, but maybe I can do a 5. So,
And I think it is healthy if we do see some price correction in housing, and then that's not necessarily a like a massive detriment that people make it up to be, because before, right, it's not. We have one big instance of this sort of like drag down, but it's more about the leverage component that was added on top of everything that caused the great financial crisis. It's not so much oh, my house went down in price by 20%, 10%, depending on the geography, right? Because I think, for example, Florida homes from the peak have already on aggregate declined to 20%. And I could see it, declining further, but that's good for, spurring consumption. So all that to be said, I'd probably also question the thesis of going long home builders here. I'm not entirely convinced that right now is an opportune moment. I would say there's a lot of, like people are saying, there is some inventory buildup there that will be competing with existing home sales. And so that's a problem in and of itself. And then all the additional, let's call it, businesses that support this industry, like a builder's first source, a top build. And then that also brings into question, to be frank, mortgage insurance firms as well. Because if I am describing a little bit of a decline in the let's say equity, it does add some risk to their balance sheet. But
yeah, it's one of those things. I actually find not the home builders as interesting. I find like the ones that are related to like home remodeling that got killed from 2021 getting like interesting. Like, at what price do you think Floor & Decor finally gets like interesting again?
home floor and decor.
Yeah.
I'd have to look, but that's also crashing, right? It's also coming down. We got to
It's below
rechange the
60.
timestamps. We are way off the times, but it's good because like we want to make sure we don't just algorithmically go through a topic. So everyone ignore the timestamps. I got to adjust them.
Like I know Trex just got blasted, which that one I understand the product's pretty solid, but I don't know what happened. But it looks like the remodeling ones, because when you're like, if you're selling a new home or whatever, maybe use Trex, but like you're going to use the Floor & Decor and all these for, they don't care if it's a new home or an old home, because it's about like, a lot of times it's about redoing the home or furnishing it or going into it. And Floor & Decor is like, I remember in 21 people were like, this company, was this Charlie Munger's like last stock that he bought?
I can't recall. I couldn't tell you.
I'm pretty certain it is. But the second they get a same source sales, but they're having the same thing, by the way, that like trucking and all these have. It's like you had this boom in 21. You pulled forward demand. You could look at like Whirlpool, same thing. Pulled forward demand. When does that demand pull forward start to subside and you go back into organic growth? because they're still growing, by the way. Floor and Decor is still growing. It's just that a lot of the growth is through new stores and all those kind of things. So net income hasn't grown. Top line has. Margins have shrunk. At some point, you get your same store sales growth back, and it could be interesting.
Yeah. We got to just keep an eye on it. And it's really just like about seeing when the real like trough in this ends up being. But yeah, just for the time being, I look at like the narrative around labor and consumer weakness, I think, is misguided. And then the narrative around housing, what if that's like the next one that people start paying attention to, and that's the next narrative that people start running with? That would be funny. Yeah, because remember, every like 2 or 3 months or so, there's like a kind of a new narrative that starts to spur, which is healthy, and it always happens. It's very strange when you're, going through the market, and there's nothing. It was very quiet.
It's very odd. You're like, and it just kind of picks up.
Yeah, that's when you should start getting worried, when there's nothing. In fact, that's like literally like what happened in February. There was like nothing. You're just like,
you're like, what's going on? Why is there nothing?
Nothing, and everything is working, right? No one is concerned about anything, and then one little thing, and then just people will lose their minds. But anyways, so we covered, and for the question, we haven't talked about the AI bubble yet, but I guess.
Quick comment on Floor and Decor, because I just checked.
Yes.
Net income margins are growing again. So I can share the screen really quick.
What I'll do is actually, I'm going to delete the actual timestamps for these.
Sorry, I apologize. Let me just show this real quick.
No, you're good. I'm just going to delete this so I can reset the timestamps as we go through them. So now as someone comes on, if everyone refreshes the video, you'll see like the more fresh timestamps.
So this just real quick, I'll show you. And I think you have to edit a stage. I can't.
Oh, sorry. Yeah, I'll bring this.
Need me to zoom in on it? Or
for me, it's good, but I maybe zoom in for others because I don't know if they're screens.
Okay. So this is just a chart of net income normalized. So net income and net income margins. So you can see like kind of a steady growth up. You just have this insane pop in 2020, 2021, and then margins just die into 22 and 23, right?
Yep.
And I wonder if I can just change it to the last 12 months to make it easier to. That doesn't let me do that. But you can see here. So for example, this, and you can't look at sequential growth because these are, there's seasonality to these.
Yeah.
Like, so for this last quarter, you had 4.8%, 4.85% net income margins. Comparable quarter last year, 4.62. Q2, the quarter before this one, you had 5.2. Same quarter last year, it looks like you had 5 flat. So they are like slowly increasing margins. So you could be at the point where you start to inflect back up, because the change from like 4.8 to 5.9 is insane for a company like this. Yeah, someone saying they did a lot of capex for a few years. It looks like it's coming down. Makes sense to me. So I don't know, they could be interesting. We don't hold this, so to be clear, but
we don't hold this, but it's kind of like they're on one of the watch lists. Yeah.
Now they're
looking at it.
Yeah. So, anyways, we can now. What was the topic we're supposed to be going over now?
The next one is private equity earnings. So go ahead and put us here. So private equity earnings, I'll put the timestamp now. So we had pretty much all the big ones report. I think we're missing TPG and Brookfield, or did Brookfield already report?
Carlyle report?
I don't remember if Carlyle reported. I know of, I only listen to Apollo's, KKR's, Blackstone's, and Ares.
I don't know if I listened to any of them this time around.
All right. Well, I'll lead through and just
Yeah.
basically, it's not a long conversation, really.
Mhm.
It's basically just like, well, the narrative going into these earnings for them was okay, fundraising weak, private credit bubble, and so let's go one by one. So first, I think we should maybe bring in our guest. That we don't have a guest, but we would never bring her on. She's actually retarded. Oh, sorry, pardon my French. Fuck, Oh, sorry, did it again. I guess you could bring up her tweets on this.
I'm bringing up a couple. Give me a sec.
We would never do that to our audience, by the way.
Twitter.
We would never, ever do that to you guys. Do not worry. But
So let's see.
so I guess while you're finding that, let's break down the narrative at first. So right now, after of course, like what happened with First Brands and Tricolor, there's been a big discussion and debate about private credit, its role in markets, and the irresponsibility or lack of responsibility in their underwriting standards and what it might be causing in the broader financial system. And so what cockroaches might be lying underneath. So when you get this narrative start to build up about, again, these private equity firms, private credit firms, and what they're doing. And the ironic part of it all was, if you look at the list of the companies involved, okay, there's some BDCs in there that, yeah, that's like a component or an aspect of private credit. These other, kind of like collateralized debt obligations, CDOs, or sorry, CDLs. Wait, no, CD. I'm forgetting the acronym. Oh my gosh.
CLOs?
CLOs. Oh, I was like CLOs, collateralized loan obligations. And so there's plenty of different funds that you could get exposure to this from. And some people were pointing as like, haha, like this, look at it. This is like the CDO, right? The CDO, the scary word that caused 08, and not really understanding the distinction between the two and the structural distinction as well. Another part about these other products is that when you look at one of them, I forget which one, I don't have it in front of me, they had an outsized allocation to, I believe it was First Brands debt, or it could have been Tricolors. Tomato, same thing. But the point is, there was a headline saying they had an outsized exposure. And I did respond to this, I believe, on X, where they were making a big deal about it. You go through and actually see what the outsized exposure was. It was still like a very small, tiny amount of the overall portfolio. But technically, the journalist is correct in saying it is outsized for that product, just because typically those products are extremely diverse. And of course, like there is always a portion or a percentage within a healthy range that they can go, part of the loan portfolio can go bust without really collapsing the whole structure or the investor in them. And you have the different tranches for them as well, for the CLOs. So the other part, which was funny, was a lot of the involvement, not just BDCs. You also had a lot of banks, just like the hell with, and so like this person's talking and I'm listening
up, by the way, if you want to look at it.
Oh, please, let's bring this up.
You got to throw it up. I have a few up here. So this
right.
one first. This is my favorite one.
Zoom in a little bit. Oh my gosh, read this out loud, please.
It says, shadow banks warning. Shadow banks are unruly, unregulated, untamed, and uncontrollable. We have been following for years. Shadow banks are connected to commercial banks in a twisted way. What happened to the regional banks today are a precursor of what's to come. My favorite part about this tweet was this response. Do you suspect necromancy? I don't even know what it means. I started cracking up. Yeah.
She's a witch.
So to your point, so did we cover, and I was looking at this because did you cover what a shadow bank is?
No, go ahead and cover that.
So a shadow bank In very simple definitions, basically, you are a bank that does not take customer deposits, does not take demand deposits as your funding source. So Wells Fargo takes demand deposits. I put my money in there, I can withdraw it the second I want. It's a demand deposit. A shadow bank doesn't do that. So an example of a shadow bank would be private credit, would be Apollo. It would be, to be clear, Apollo's private credit arm, not the entire thing. Someone got very upset when I said Apollo's shadow bank, and they were like, "No, they do private equity." All the private credit players. If you there's a lot of like local banks that people that I know like that do lending to usually specific industries that are shadow banks. So
Like a BDC would be a good example,
yeah,
right?
yes,
So
yeah. In fact, someone actually in this post, this is back in October, called them out and said like, post data, our BDCs seeing higher defaults, see default rates spiking, high yield or leverage loans at this point. Yeah, but so all it is that they don't have demand deposits. It means they have different regulations, but it doesn't really mean anything about the quality of your underwriting.
no.
You can be Blue Owl, which is very risk on. You can be Apollo, who shorted First Brands debt.
Yeah. Yeah, because like what this person is, because I know in the context of what they're saying, they are referring to private credit firms, private equity firms like an Apollo. And I think they name dropped them in that discussion that they had. Not in the tweet, but in the discussion they had. Oh, I mean, you have.
Oh,
she's
yeah,
calling
yeah.
out. So you got to understand that this person's intellect is so expansive that in her argument, right? She makes a case, well, which we'll get to the BNPL stuff, which is also hilarious. But in the argument she makes, and she calls out a specific firm by name, that firm, ironically, in what she calls a red flag, and the fourth private credit disaster, not in the, okay, so we'll get to that. But in the other tweet she was talking about, they profited, they shorted those loans along with Oaktree, by the way. So it's the two firms, Oaktree and oh wow, private credit firms.
Yeah, and I think the reason like I see this person a lot and just makes me laugh is like there's someone that's spreading a lot of fear. Now, remember, this person is a short only research selling firm. They sell short reports as that is what they do. So they have, whether they realize or not, your subconscious bias is everything negative because that sells your product. And like I said, it might just be subconscious. It could just be you're seeing these things because that's your lean. And to be clear, I mean, I short things, I long things. I don't have a particular bias. I mean, and making money on a short is more enjoyable for me than a long in a lot of ways. But so, I'm not just like a long only person or a long only like fund or anything looking at this and saying, I just see this because I'm long only. No, I mean, I look at both things. It's just what she's seeing doesn't make sense. And, I'm not trying to pick on this person in particular. They just, a lot of things I read. I also, and I don't want to sound rude on this, I question the legitimacy of their background because they say they had 10 years of accounting. I've never seen someone with less knowledge of accounting than this person who's worked in accounting. Like, I think, what was this one over here? Like, AI accounting gimmicks is making Carvana look like a freaking saint. Maybe she's talking about AI asset-backed securities, but AI accounting isn't a thing. So, anyways, I don't want to spend too long like bashing on this person, but I'm sure like in the things that she is an expert in, she's probably pretty decent. I think she's a bit outside of her wheelhouse. In fact, she's even said like, I don't think she understands ABS very well, and I think at some point she kind of hinted at that. So I don't want to sit here and bash a person. So we can move on. But the point is that that's been the outstanding narrative.
She is right to use Carvana as an example of a bad actor. I'll give her that.
Oh, for sure. But like,
That's it, though.
do I want to go down this rabbit hole?
Oh no. Okay, we don't have to.
If you're a short seller and you're selling short like research and your thing is Carvana, like get another job.
Oh, I made him go into it.
Like everyone knows Carvana's.
Wait, Captain Happy Pants is a good comment. That's good. It's just 10 years, but it's the first year again and again and again.
So yeah, it's just it's one of those things where and you know, we both worked in accounting. I'm a CPA. Like I've the things that she was confused on, if you're like a first year audit associate knows, or if you've ever been on like any audit, even on the client side, like in your PBCs, you're going to understand like what sampling is. So
yes. I bring up the point about sampling. That's a good one. That was like a dead giveaway about her lack of accounting experience.
Yeah, so she was talking about the asset-backed securities, maybe in particular for Carvana, I don't know. And she was like pointing out how the ABS or how the accountants are doing a poor job, which like, yeah, whatever. I can talk about how, anyways, we're not going to go into that. But her example was when the auditors are testing the loans, they don't test every loan. They just go to the person, they pick and choose and say, give me these loans and let me test them. And I was like, that's sampling. Everyone does sampling. You cannot test every single loan. You can't. So anyways, that's just
Wait, no way.
Aerojet Rocketdyne. Oh,
and you know what's funny? Andrew and I didn't know each other. We were both longing it and not knowing each other. And I think when we first discussed, then yeah,
because was it Lockheed was going to take him private, and then that fell through, and then it ended up being like,
because that one was such a good, like, that was so layup because they had the real estate that was worth almost as much as the entire company. Yeah. And so I knew why the Lockheed CEO wanted it, because he came from American Tower. He was a real estate guy. Yeah. And he comes in and he's like, dude, we buy this thing, we get the rocket tech, and then we sell the land. It's like, let's do it.
It's free. You get the rocket tech for free.
Yeah.
And that, good times.
Yeah. And that one was a good one because, like, while things sold off, you had that just just go up like a box.
Should be like that. No.
Yeah. I was like,
I'm trying to, because I'm going like this. Okay, there we go. But that was good times. I was long Parian at that time too, and then I shorted it later.
Well, we're going to be doing more regular content here because I'm doing this more full time. So glad to have you back. Glad you refound the channel. That's a throwback. Aerojet Rocketdyne.
Oh man, good times.
Yeah.
Everyone's getting like cooked, and we're like, oh, we're happy. You're like, I have Netflix and Aerojet, and I'm chilling.
Yeah, and Activision Blizzard.
Oh, did you have Activision Blizzard?
Yeah, I even made that was when I was experimenting making memes. I thought I made a pretty funny meme about the acquisition, and it was like the scene of General Shepard where you hand him the device and he shoots you. And there was like, it was before the acquisition was announced. It was like me, making fun of like the analyst downgraded Activision Blizzard, and it crashed. And that's when I was buying it. And then literally not even that long later, not long after, they got acquired. And it was around the scandal, the sexual abuse scandals.
That's right. What was his name? Bobby?
Selling off. And then I pick it up. And then I think it was like literally 2 weeks after that, meme video where I was just having fun, just like Adobe. And then it got acquired, and then the stock just jumps. And then the rest
that was unironically probably like the most value destructive event for like FinTwit, because after that, FinTwit like tried to go. I even got along like iRobot, Spirit Airlines, Capri Holdings, because they were like, because like Activision was such like people made so much money off that they're like, oh, let's do it again, and you got suckered in and screwed.
Yeah.
Yeah.
Yeah. Oh, Rick's was like, that was a saga. So I don't know if you knew this, Rise Aries, but there was a lot of interesting findings, like the existence of multiple jets. So I think they've cratered quite a bit.
But $23.
$23?
Well, they're also, remember, they investigated for fraud.
Yeah. Yeah.
So it doesn't help. It's usually not a good thing if you want your stock to go up.
Yeah, investigated for fraud. The jets, the multiple jets. Oh my gosh, bombshells. Just like a disaster of a company. Yeah.
Yeah.
But
the interesting ways that they held their earnings calls on Twitter and all that. Anyways, he deleted his Twitter, so there's nothing the Feds
can do. It's all gone now. So the long story short with private equity. Okay, just to summarize the calls. So we get the narratives. They're having trouble funding. Private credit bubble, blah, 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 blah. Again, we just kind of told you guys that Apollo shorted the debt. They made money from it.
Well, to be clear, the reason people are saying it's a bubble is people are basically acting like private credit was just indiscriminately loaning out money.
Yeah. And then when we listened to the calls, each one of them stated they're actually showing record pipeline growth. They're raising lots of capital. There is no issues that they're seeing. The one thing KKR had, there was an issue. Their returns in one of their Asia funds was lackluster, and they had to give back carry.
Really?
Yes. So Apollo's still OP.
Asia. I wonder where in Asia it was focused on.
I gotta look in, but they had to give up carry. I forget from what vintage, what year.
That's surprising because most of their funds had historically had very high IRRs. So I don't know, but anyways, it was a North Korea fund. Well then. But yeah, so and that's basic. Mm-hmm.
Wait, sorry. They're just shouting out names and they're catching my attention. Unum. Man. And you know what? I should have held on to Unum. I just checked their price. Holy crap. Oh my gosh. I think that would have been, instead of like a 5 or 6 bagger, I'm pretty sure it's like, oh wait, they had a sell-off in July. Oh. I thought they would be up even more by now.
Yeah, they kind of had like this bar that went down a lot, like really fast.
But it would have been like close to more than an 8 bagger because I had like a yield on cost. It was like 15%.
That's insane.
No, dude. In COVID, you had like layups out there.
Mm-hmm.
It was nuts.
Oh yeah.
But
yeah. So, I mean, the big thing for me was everyone was worried about private credit bubble and fundraising, like you said, and it basically they're like, nope, we're fine. Everything's okay.
Yeah, honestly. Yeah, exactly. And then so now that has been dispelled, but we're going to be talking about that detail. It's like what's happening with earnings, right? But before we get to that, let's get into the next topic because I think this is one that I wanted to make a video about because there was, and I tweeted about this. We had some members ask me quite often about Fiserv, and they asked about Fiserv in the context of PayPal. I think it's because there was like a lot of content that they were watching that was making the comparison, and so we do in the club a lot of discussions. I would say it's daily discussions.
It basically is, yeah.
Basically, yeah.
And we don't charge $15,000 for them. Okay, It's whatever the price is to come in. You can be in the daily discussion. You have to pay 15,000 to get a call.
Oh yes, Antonio Linares. Yeah, I was like, what do you mean? We do charge 15,000. Yeah,
Yeah, but it's split two ways, so it's 7,500.
so no 500.
Yeah.
But I think there was an entire also like weekly call, like the official ones, not the impromptu discussions, but just dedicated to talking about Fiserv. And one of our members, I posted their comment on Twitter or on X, because they were a person who was really thinking about building a very large position or sizable position in Fiserv. And let's kind of talk about what it looked like. And let me try to grab a chart so we can kind of visualize this. Oh, okay. Oh, he's giving it $20,000 super chat. All right, take it or leave it. Oh, wait. I have to. Okay, because it's a super chat, and I apologize for everyone who has a youngin in the room. You know, there's a generational gap. So if they're watching, please cover their eyes, because the following will have an impact on their mental state. So I'll give you 5 seconds.
Is that a super chat?
Yes. You don't understand.
I don't. It doesn't look like a super chat.
It is no, not that. This one, I skipped over it by accident because I forgot about it. But Seymour is like, it's a super chat. I gotta show it. All right, you were warned. All right, super chat was shown. If you have anyone in the Zoomer age or bracket, I apologize if they're watching and now they're like just spamming out or spazzing out, saying numbers. You got to grab them, hold them to the ground, just make sure they're okay. Let them get through this, their system. See, like Fuhat's already, he can't even help it. Like Fuhat immediately gets triggered because he I don't understand it. But okay, we satisfied the obligatory super chat.
I feel like back in like the 1960s, like if your son came out as like a homosexual, you get like slapped and disowned. I feel like that's going to happen if my kid says that 6'7" constantly.
Oh, just out there. See, Doc's gonna be like, Andrew, why'd you do that? Like he has you on speaker, like this video on speaker, and then his kids are walking by, and you just hear you say it, and they go, oh, and they just start saying it for the next 5 hours. Oh man, what have you done? What have you done? No, but it's like I guess. Anyways, it's more fun. Yeah. All right. So I was gonna bring up Fiserv. So, and again, this is not like the stock price is down. This is not hindsight is 2020 kind of moment. We'll talk about what our discussions were centered around and like why it was fairly obvious at the time why this was more trouble than people gave it credit for.
Are you sharing your screen or are you just looking?
I'm getting this
just,
ready. So I started getting asked a lot about
oh dear.
That's super chat. All right, we'll get to that. I don't know what that means. So lost my train of thought because that's super chat. Anyways, so let's talk about the initial drop. So the initial drop comes off the back of initial concerns about guidance cut and slowing growth, right? But what are some of the preceding issues? Because we'll talk about that. Because this is when I started getting a lot of questions. Because if you zoom out a little bit, well, it's like, well, hey, this is a high flying fintech, growing steadily year over year with a sticky core business, right? The banking core business, very sticky.
That chart. I'm just saying the chart. It's like, oh, we believe. No, we don't. Oh, we believe. No, we don't. We believe. No, we don't. Maybe we believe this time. No, we don't.
Oh yeah, this death toll is insane.
But like, look, because then like finally people are like, well, we don't believe in and there's some people like, I believe a little bit, and then it's like, no, you don't.
Oh, no, you don't. Yeah, that's a wild chart. Yeah, this is a wild chart. Someone is building stairs. So anyways, so coming back to the situation at hand, I understand what brought the initial attraction, because if you ignore the fact that it's a bit more of a complicated business, and there's a lot, at least under the hood, and some nuances to the quality of each product. It looks on paper very attractive. If I pulled this up on any data aggregator, I would also think it's a very attractive stock. It looks cheap on a trailing 12 months basis, on a sell side forward estimate basis. Okay, so then what do they have as a business? So internally, you have to focus on the merchant acquisition business, which is going to have, merchant services, Clover, etc., all of that. Then on the other side, you have the stable, steady Eddie, low growth banking core business. And so when you looked at the two, you get a kind of a bigger picture of what they're trying to achieve or what they're trying to build. At one point in time, this was over $100 billion company. This sitting at now roughly $30 billion in market cap. Now, on an enterprise value basis, even when they were trading at the discount at 70 some odd billion dollars, they were actually trading at an enterprise value of 100 billion. That's because they have about 30 some odd billion dollars in debt. I believe it's a little bit less than that. But the point is, it's a decent amount of debt relative to the free cash flow that they are generating. If you assume the free cash flow will remain steady and not grow too much, because that was the excuse that the management had, was on a go forward basis, they were going to grow free cash flow at a steady clip and they grow their way out of the debt. So one point that I brought up to the members when we were discussing this was when I just took a look at, even just the last earnings call, the management said, and I quote or a paraphrase, our target leverage is 3.0 debt to EBITDA. What were they currently at on that call?
2.9?
Yes, you heard me. Yep, 2.9. You heard me rant about this. It was like, what the hell? 2.9. And so a large part of the thesis that I saw online was this was a cannibal story. This was a stock that was going to, or a company that was going to buy back its own stock in droves. And then through that, you're going to get a push up in EPS, yada, yada, yada. So that's all well and good, except as far as like capabilities go, they've already tapped the debt markets enough. If they're going to change their leverage target, then that's a different story, but you worry about the health of it. The argument why the debt wasn't a problem or isn't a problem is, okay, they have the stable core banking cash flows. Now, I'll talk about the tail risk and put that to the side because we'll get to that because there's a real tail risk of bankruptcy, but if something happens, and we'll talk about what that thing is. And then while that stable business was operating and producing, all this and spitting out this cash flow, they had this growing business in Clover, in the merchant acquisition business, of which you have three major players at the very top. You have now GPN, which has merged or taken the part of WorldPay for the merchant acquisition services. Second, you have JP Morgan Chase as the number two. Yes, they're huge in this space. And then third, you had Fiserv. So this business is generating a lot of interchange fees. It's similar to if you can think of it like a Visa, but not a Visa, because a Visa is the actual payment rails. They're taking zero credit risk. And technically, the banking acquirer or the merchant acquirer is taking on a credit risk. So there's a compensation for credit risk, but the credit risk is fairly low, granted. So that in and of itself should be, attractive business, grows in line with total payment volume through its network or through its system. And the Clover business, kind of this whole thing that puts or integrates with everything quite nicely, and they can go to their banking core clients and upsell them on Clover. In practice, what we heard from industry insiders on this matter, and thanks to one of our members who shared with us, various interviews, the discussion from some of the customers, and this was actually funny enough, post the crash when we actually saw what the customers thought of it, but we knew this from just having discussion because it's part of what the value is of the investing club is. Like, you have a bunch of people from different backgrounds, and these different backgrounds come with their own experiences, and we all share it with each other to kind of form and create new ideas. And so one of the things that was kind of discussed and known was the quality of the banking core product compared to what else is out there was very poor. And the customers themselves, they know this. They know that it's a limitation on their go-to-market. When they try to create a new product that, let's say, the newer, faster-moving, nimble fintechs are doing, they want to do that, but they can't do that. And the limiting factor is their core product, their banking core. So the customer is upset with you, and you're doing nothing to fix it. And frankly, it's probably very difficult to fix. And another part funny factoid about them. The work culture, from what I gathered, was actually pretty poor for at least if you were really good and talented, you didn't ever stay at Fiserv. They had a really big problem with maintaining a strong talent at Fiserv, at least as far as the technology side goes. You wanted to say something?
Oh, it's just funny because you know you're more on top of this, or are more on top of this and like its competitors and stuff than I have been. So I guess I haven't been paying as much attention. I did notice I went to a local restaurant the other night. I know for a fact 2 years ago they had Clover, and I know for a fact they had Toast the other night.
We'll talk about that.
Those are facts. So
yeah, I know a lot of restaurant operators. Okay.
Yeah, no, because you do. I mean, I don't, and you'd always be like, dude, Toast is so much better. And I'm like, I don't know, dude. I just like give them my card. And they...
you don't notice it. It's it's the restaurant owner that notices it. But I know a lot of restaurant operators, and it is 6 for 6. Like 6 out of 6 are all like Toast, and they all switch to whatever. Yeah. What?
6 out of 7? 6, 7? No. Okay, moving on.
I apologize for Andrew's behavior. Just take your kids out of the room. They can't be in the room. Okay, so, look, like adding. Okay, I'll add you, Aries, to the 7th person. Thank you. You see, look what you do to Fuhat. He can't even help himself. All right. So parents have a restaurant business. They just switched from micro POS to Toast 6 months ago. Toast way better. Oh man, I know. I hear it all the time. And it's funny because it's like the restaurant owners themselves are like advertising it. I don't even own a restaurant. I don't care about, well, I care about it now, but I didn't care about it in the past. And I would hear incessantly when I would, be at an activity with the person I'm thinking of, and they would be like, yeah, man, like, well, I care because they're my friend, but like I wasn't like, I'm not in that world. I don't know what, why you're so excited, but I'm happy for you. But he's like, man, I just switched over to this new product. I don't know if you've heard of it, Toast.
The thing I find interesting is the question is, because this is an interesting question for Fiserv and Toast is,
I'm telling you.
At what price? No. At what price would you actually go to Clover over Toast? What price does Clover have to drop to?
I can probably tell you, because of like the integration and the built-in capabilities of Toast, probably quite a lot. Because when I say it's like what he's saying, that's what I know. That's what I know. They advertise it to each other. They advertise it to me. I don't own a restaurant. And they're like, hey, I'm really happy about this product.
That's really cool, really man. Like, awesome.
But no, you know what was shocking to me back in the day was like, this must be a very good product. This must be like really good, or he's like really happy with it because he wants to, like, we're just at the gym, like what are we talking about? Toast, this POS system. But he knew I was into stocks, and he was like, oh, are they public? And he wanted to bring up that conversation. At the time of that conversation, they weren't public. And they've actually, he's been with them since then, and it's like the capabilities that they've added along the way. It's like, they're almost like a different company. And at one point when they went public, of course, they were at a crazy valuation, and they got to a point where they were really attractive. And I would say now, for full disclosure, they're really attractive now. But getting back to Fiserv, because that's just on the Clover component, they're getting, and Andrew brought up a great point, because we're going to get to that exact point he brought up. But the core business, lackluster, customers hate it and would love to switch. It's just very difficult. So that's their saving grace, how difficult it is to switch. Their competition, the neo cores, they are working day in and day out to get one case study. And that's all they need. They need one case study, one bank to successfully make the transition. And that bringing back that pin we put on about 15 minutes ago, bringing it back, that's the tail risk right there. Boom. So you want to ask, how does this go to zero? That's how.
I don't think that the market's saying that there's a decent chance that they're going to zero.
Well, I would.
The market's assigning almost as much value to the debt as they are to the equity.
I would put that as a non-zero. I was putting that as a non-zero chance, as like a tail risk.
Like I'm not saying, I'm not saying that they will, but you're going to have Clover continue to do price cuts.
But if it continues to do price cuts, it's not going to grow. It's what the former PayPal management did. That worked out well for them, didn't it?
Mm-hmm.
So, which we can talk about PayPal too. But
I just want to talk because you didn't mention it, or maybe you did. I missed it. They talked about, you said they were at 2.9 times debt to EBITDA, and they were talking about doing 130% of free cash flow in buybacks in the year. I remember sitting there and being like, I was like, how are you going to make that work? And then before they announced earnings, they did it. They like, hey, we're doing an acquisition. And we were all like, dude, what the hell? Like, what are you doing over here? And so to me, it feels like, I mean, you can kind of see it. You see the stock price. It feels like management that's kind of floundering.
Yes.
It's a PayPal situation with a more problematic debt load.
Yes, and this is to illustrate it perfectly. This debt, which
did they acquire Clover or something? What's the
no? Yeah, that jump there is the acquisition of First Data, which included Clover. Which, by the way, fun fact, I was a shareholder of First Data. Yeah, they bought it off me.
So you're a fan of Fiserv?
Yeah, and I kept track of them. I kept track with them, and I saw their share price continue to go up at one point, and I was like, oh, okay. But when I did more research in the industry, it became clear to me Toast was the best by far. The problem was the price, but the price became really good in 2023.
Mm-hmm.
And fortunately, I day traded that stock. Day traded as a joke, swing traded that stock. I should have held on to it. And now we're back with involvement in Toast. So because on this recent pullback, I think that was an opportunity to accumulate. Well, we're still in the pullback. What am I saying? So I'm not saying this as like, oh, in the past. No. I think right now it's the pullback's interesting opportunity. They're growing. I think in accordance with their valuation, which puts them at a decent value, and they're going to continue to dominate, and they're expanding internationally. There's a lot of green space for them out there. So, and one fun fact about Clover or Fiserv was they actually were experiencing a lot of growth, not in their home market, United States, but in Argentina, which accounted for quite a bit of their growth.
That's so weird.
So weird, yeah. So now looking at this business, I mean, I'm not really attracted to this turnaround kind of story. It's not the kind of turnaround story I like. I'll treat it the same way I treated PayPal, which in my last live stream, I commented on the PayPal grave dancing that I see all over Twitter from people who I don't recall being bearish PayPal when it was like above $100 a share, or even higher than that, right? So it's like, I remember because I did videos calling people out for the valuation models, saying that PayPal was worth $300 a share. Yeah, people were on drugs in 2021. I could tell. People were doing a lot of drugs. So we're talking right now, like PayPal is not a $300 stock. It's under $70 right now. So with PayPal, you had the CEO transition, and then you had time to watch that CEO make changes. You had time to wait. You didn't have to buy right when he got in, and people were hyped. You had time to watch everything happen. And I think now you're seeing that he's actually transferring. And our other partner, Garzi, right? Even he's at the point where he's also saying like, yeah, what they're doing is working. It's a matter of time now before it's rewarded. And that's all it is. But if you're long now, but you've been long for years, you're exhausted, and that's understandable. Of course, I'd be too. If I'm being honest, I'd be too. And that's why, when we're talking, Andrew and I, when we're discussing this in the background, we're discussing only the question of timing. That's really it. I mean, we're not discussing the question of like how poorly they're going to do or whatever. It's like, okay, they're probably going to do well. Andrew has a different opinion on the timeline. I actually don't necessarily disagree with you. I don't have necessarily a counter to your opinion.
I don't necessarily disagree with you, but I don't agree with you. So
no. I'm saying I don't have a counter to your opinion, because absolutely your timeline could be more correct, and in which case it will turn out to be the case to, we could have waited even a little bit longer.
Sure. Yeah, with them, my only issue with them is I just feel there's more attractive players.
That's the beauty contest. Absolutely.
Yeah. Within the same space or same theme. And that's where it becomes a problem. But yeah, I mean, I think it's one of those companies where you look at the valuation on an absolute basis at the valuation they are, at the acceleration of growth that they're having. It seems really good. It doesn't seem like,
I view it more as like it could have an extended momentum from, the business reaccelerating, which we're seeing signs of, and that's what I was waiting for this quarter. Will the business show signs of reacceleration, Venmo monetization, and Braintree reaccel? We got that. What I'm thinking will happen, or I bet maybe will happen, is that sentiment shift, which is why it's more of like the small trade within a portfolio, not necessarily core.
It's right? Like with Google, it's like once the sentiment shifts, you just get a grind up no matter what.
Yeah.
Same thing with
yeah, exactly.
Well, because I just got out too early. I told you at 160, I was like, Google's not losing in AI. Like, this is a little bit of a rant, but if you're a finance person and you don't actually work in tech or work in AI, and you're just making judgments on who's going to win in AI, and you think that you actually have an edge, you're like, potentially you should go see if you have a mental disability, because you don't know anything. Go talk to the people that know stuff. And I talked to the people that know stuff, and they're like, Google's doing a ton. Google's very advanced in AI. One individual I talked to, they're very, very positive on Google and Meta, and not so positive. And they're also, this individual also thought that they just had a lot of respect for Elon Musk as a founder and a leader, and thought Grok could also do well. Wasn't as positive on OpenAI or Anthropic. They like Anthropic. They just think they'll be resource constrained. But you want to talk to the people that know stuff, and that's same thing goes for this too. If you listen to some idiot on Twitter who's I don't know, an engineer or something, they probably don't know a whole lot about this space, and you probably should listen to other people.
Yeah. No. And what I found fascinating was in that person's comment, which say they're very particularly familiar with the matter, right? People familiar with the matter as a source. We won't say but the person is very well educated in this space, extremely.
Yeah.
We would have zero reason to question anything.
Yeah, and
we're not on the same level
with the AI one. This one individual I spoke to, they've met with the head of DeepMind. So they're in that echelon. So anyways,
yeah. The comment on Meta was interesting.
Yeah, I will say because this is the thing too. It's finance people are also very bad, I think, in general, understanding how businesses work. Rome wasn't built in a day. You gotta. Zuck's done just an amazing job. I mean, he's literally founded a freaking company, maybe the only company in the world that has 3 to 4 billion daily active users or monthly active users. You could, I guess, count Google maybe if you consider that same thing. But and people are like, after one quarter where the market reacts negatively, they're like, he's doing too much capex. It's like, I'm sorry, who are you? Why? Well, what makes you think that you can like put an opinion? You're just reacting to stock price changes. So,
yep. And I think for like what Meta, which we can get into the next segment, which is big tech earnings, because there's actually quite a bit to get in there. Let me go ahead and put the timestamp 01. So one thing that's exciting about big tech earnings is we actually got to see a perfect example of efficient market hypothesis at play, where it in and of itself, the theory is not disproven by this, because this was something I remember back in my college days where my professor drilled it into our mind that inefficiencies in the market do not disprove efficient market hypothesis. But people misquote or misuse the theory to just say at any given point at all times everything is perfectly priced. Efficient market hypothesis does not say that there are no inefficiencies in the market.
correct.
By the way, due to efficient market hypothesis, you are able to actually profit from investing and being right. Due to efficient market hypothesis. Fun fact for everyone. Yeah.
You just made strongman pop an aneurysm.
No, he would agree with that. I think
Okay.
so. Like, but if you didn't have efficient market hypothesis was not correct, or we do not observe efficient markets, investing would literally just be like throwing darts at the dartboard, random chance, not connected with that, anything.
Mm-hmm.
But because things will get priced in when and what I think is, and this was a discussion I was having earlier today with someone else, like on this actually very topic. I think it more in terms of like the observation has more to do with the focus of information at any given point in time. Oh my gosh, Sam, I'm not bringing that up. Thank you for the super chat, but that like AI erotic stuff is not being brought up. So, so like it's kind of like what Howard Marks said, right? About narratives, about what the market focuses on, and it could be positive or negative, because efficient market hypothesis or inefficiency in the market can be formed from both positive or negative forces. As in, we could have exuberance and we could have pessimism at some point in time. We could have made up facts, right? Made up opinions, or facts that people don't want to grapple with, right? So, give an example. Again, should in theory be a company that everyone's paying attention to. No one should be shocked, but yet, and I'll give the example because we talked about this extensively, and I was like, I'm going to laugh when this happens. Amazon. Jassy tells us there will be a slowdown the next quarter, followed by reacceleration in the quarter after. Okay. Well, we get the slowdown the next quarter. Okay. Market does what? Sells it off. Market narrative becomes, go anywhere you can see, Amazon is losing in the cloud.
Mm-hmm.
Yet, Jassy informed the public information, this will happen, then this will happen. Historical track record, intact, as in usually look back, credible CEO says this will happen. It's not like Elon Musk. This will happen next month. It happens instead in 4 years. Different CEO. So theory, efficient market hypothesis, how it's misused would indicate, and your predicted observation would have been, Amazon would be flat to up on those earnings, or just like no reaction to the AWS figure. Nothing. It would have been nothing. It would have been on, maybe something else, a surprise.
Advertising, yeah.
Yeah, advertising, would have been focused on something else. And then simultaneously, you would have not seen the reaction that you saw 11% up in a day when AWS reaccelerated, because that should have been priced in. Because not only that, he reiterated the reacceleration in the prior quarter. And not only that, you also got Semi-Analysis, give him credit for that, for releasing the data that showed there was going to be a reaccel due to the Anthropic adoption in the later quarter.
No one cared.
No one cared. So the misuse of efficient market hypothesis states, as people believe it and they misuse it, that price movement could not have occurred or should not have occurred because it was public information and would have been priced in. What I think in more reality, the observation, because it doesn't disprove efficient market hypothesis, but in reality is what people are doing is they concentrate on different things at a different point in time. They can get distracted. There's going to be multiple pieces of information at the exact same time. And you as an investor have to, sort of breeze through that and figure it out, right?
Yeah. It's like Subula says, nothing's ever fully priced in, or nothing's ever priced in.
It's like, it's kind of a meme at this point. It's like sometimes people are like, oh yeah, it's definitely priced in. Dividend cut happens. As an example, it's like, oh, the dividend cut's priced in. Dividend cut happens. Well, it wasn't priced in.
Well, that's a good example of a dividend cut is something that's good. I think a good example of something that can never be priced in until it happens, because a lot of dividend companies, if they've had dividend for a long time, they're in those ETFs that are based on you raising your dividend for X amount of years. And the ETFs have rules. It's like, okay.
Yep.
And so until you cut the dividend, the ETF does not dump you. And then you cut the dividend, the ETFs dump you. So that's actually an example of something that cannot be priced in.
Yep. I just wanted to bring up, I forgot I didn't have the Amazon chart in front of me to show everyone. So everyone sees that dip in the middle. That's right there. Mm-hmm. That's the narrative build out of, Amazon is behind in cloud, behind in this, behind in that. And yet should have been public information. We were all reading the same filings, the same transcripts. And yet somehow market was surprised in the last quarter. Somehow. But okay, so I rest my case. I think I made my point.
Other thing I'll just say, little pat on the back for me being psychologically short trade desk, but actually taking the short.
Hey, okay. No, you know what? Talk about it, because I'll back you up that you were suggesting, hey, I think we should short trade desk. I think we should short trade desk.
Because basically, if you understand how the ad market works, you have the walled gardens, right? Walled gardens are Meta, Google.
Yep.
Can I say Microsoft?
Yeah.
Amazon isn't really a walled garden. Amazon's they're becoming one, I guess you could say, but not really. It's still in the open web, which is the rest of the advertising market. Amazon is growing really fast. That growth is not coming at the expense of Meta. It's not coming at the expense of Google. It's coming at the expense of the open web. And so my thesis was, when Trade Desk, because Trade Desk is always traded at just insane valuations. So the thesis was, Trade Desk has said like, oh yeah, we've had some internal slip-ups, we're internally messing up or whatever. It's like, your internal mess up is that you cannot compete with Amazon, but you can't say that. So all you're saying is, yeah, we're slowing down our revenue growth. And it's like, yeah, because Amazon is coming and eating your lunch. So that was my assumption. And to be clear, the revenue growth deceleration, did it continue? I want to see if it continued in this quarter.
For Trade Desk, right?
Oh, it did continue in this quarter. They're continuing to decel. You went from like 24, 22. It's like 23 to 19 to 18 this quarter. Also, so much SBC.
Yeah, that company will make money for everyone else before they make money for the shareholders.
Their Snapchat model.
Disgusting.
Yeah. So, but yeah, it wouldn't have done the most amazing compared to other shorts, but like, I still think, because people kept on asking, because this very similar to Fiserv. It had the drop And after drop, people are like, when the first drop back in, if you pull up the chart,
Yeah, I'll pull it
up. People were asking me on that first drop, they're like, is trade desk a long here? And I was like, nope, it's closer to a short than a long. I said, I don't think you want to go long this until like mid to low 20s is when I think you consider it as a long. And I still hold that view. In fact, it might be going down as the revenue decelerates. But yeah, that was kind of my initial thought.
Yeah. So, and to summarize, so you looked at the Amazon advertising strength as there's a loser out there. Who's that loser? Well, it's coming from the open market. That loser has to be. Bada bing.
Yeah. I mean, and it doesn't mean necessarily that Trade Desk is explicitly the loser. But what it means is they can't be winning as much as they were, and they were priced to continue winning.
Yes.
Like going back for a while, people were asking me like, why don't you? Because for those that don't know, for a long time I've covered and know ad tech fairly well. I'm not like I would not say I'm an expert. I'd say compared to most people like in the financial markets, I know more than most. But and people be like, why don't you like Trade Desk? And I was like, how can you justify this valuation? It's insane. And they're not really a company that has that. It's a DSP. It doesn't have like that much of a moat. Like a big player can come in and start to kill their moat. That's I think is happening.
Yeah.
Because they're a DSP. Amazon is a DSP. Amazon's DSP is winning.
Yeah. And real quick on because it's on big tech earnings, we can talk about Google, and I think people will find this very helpful because we already had this discussion. But on Alphabet, why is the sell side estimates so low, right? Because if anyone's watching, we had this discussion internally in the CM community because other people, were rightfully so, just saying like, oh, the analysts just like are wrong. But by the way, not for Amazon, granted, for Amazon, analysts have a very shaky track record at predicting EPS. Also granted, because EPS is also not a very stable predictor for Amazon. Mm-hmm. Like you just don't know with Amazon. Amazon's typically, and this is going back to Jeff Bezos' original letter, where he stated the best way to track Amazon's business performance is cash flow, and just to focus on cash flow as your proxy. And then in reality, it's actually true free cash flow, which is operating cash flow minus maintenance CapEx, and you're supposed to reduce that CapEx figure by the growth CapEx because you're not supposed to punish a company for that. But coming to Alphabet, well, Alphabet EPS seems to be estimated to grow only 8% next year. Well, you look at that and you're like, that's really weird. But there's a very good explanation for that. And Andrew, what is that?
Equity gains.
There you go. So in English, the analysts are not, and rightfully so, the current EPS for Alphabet include equity gains. It includes SpaceX and Anthropic. So together, I believe they have roughly just under $20 billion boost to Alphabet's earnings per share. So analysts look at that and say, well, first of all, that's not a repeatable event that we can predict, right? We don't know if that's going to continue in the future. And also, second of all, as an investor, you should kind of put some, percentage value to that, where you're like, do I care about this, or do I care more about the core business and its operating earnings, right? And earnings per share. Mm-hmm. So analysts took that and threw that out, right? And so from the adjusted EPS of this year, they're probably going to grow more on lines of 16%. So and then on your data aggregators, when you're going on your data sources, everyone, if you go on them and you look at them, you'll see sell side estimates next year, roughly equating to about 8% growth. You'll be like, the hell? You might have thought they were wrong. It's like, no. There's a good explanation for that. So if you adjust this year's EPS to a normalized figure, removing the equity gains, then the growth rate expectation from this year to next year is actually roughly, I think, like 16.
Yeah. I mean, the way that if you want to do it, just look at the EBITDA number, the EBITDA estimate.
Yes.
I know like some people on YouTube and Twitter don't like EBITDA. I generally do. Like you can just do an EBITDA to free cash flow ratio to figure out. But sell side has EBITDA margins growing next year.
Yep.
So I don't think it's any issue with any of that stuff. So
correct. And so yeah, when that 8% is probably correct, but because it's coming off of a larger base, that does mean that Alphabet is trading at a higher multiple than what people think. If you're trying to look at the core EPS,
higher or lower?
It should be at a higher multiple.
Okay.
Because you're reducing. Yeah, not a lower multiple. It is technically at a higher multiple than what it appears to be. It will grow. So that forward EPS is probably the true EPS estimate, right? Of what the analysts think are going to be. And they tend to be, for Alphabet, pretty accurate. They tend to be. If you actually look at historical analyst track record, an aggregate for Alphabet, it is a company that, like I was making like a joke about how people, even in companies where everyone's paying attention, there can be mispricing. But to be clear, the analysts, the sell side analysts on Alphabet have been decent at predicting at least, that forward EPS figure. On the note on, like, for example, I read B of A's note on Google throughout the entire fiasco and fear. The analyst there was pretty straightforward, like bullish all the way through. And his point, one of his points in one of the notes was very interesting, and I'll relay it out because as a risk, because I don't want everyone to think everything's hunky dory. In the background, Andrew, myself, and Garzi, we might debate and disagree on these risks a little bit, but one of the points that I thought was, really well thought out, and this is coming from an analyst who is a bull. He said it was foolish to be Google this year. Or sorry, foolish to be bearish. I apologize. Foolish to be bearish Google this year because all the bearish arguments are too early. So, yeah. And being early is wrong. So what was the point being made? Well, right now I say, Andrew, you're my marketing executive. I'm going to give you this money. And I have these advertising campaigns that we have. And this one is for search, advertising, social media. Where are you going to go? Okay, so for social media, you have a plethora of options. Well, hold up. You can't go to ChatGPT right now. There's no other option. So, yeah. So where can you go with the search budget? Because that's not the same kind of ads. You don't put search ads in Instagram.
You can go to Bing. I mean,
okay, would you really go to Bing?
Of course.
Would you waste my money on Bing?
I mean, who are you going to get? Maybe I think the algorithm's better.
Yeah, but who are you going to get? Like some not there's anything wrong with grandmas, but some grandma who forgot to install, Google Chrome or forgot to install or go to Google.
Yeah, that's the people I want to dupe into my product. What do you mean?
Okay, well, okay, there we go.
Google. Answer, yeah, Google.
So the part of like within Google, right? That as like when you're saying an alternative, does an alternative exist? Right now, there's no alternative, and so Andrew is going to basically put the entire search product or search budget into Alphabet search ads. And the interesting part about what the analyst said was like, again, they were bullish the stock. If you're bearish this year or in April, you're foolish. You're too early. Not foolish. You're too early. And that you have to wait more so for next year, because next year is when the alternative comes, the true alternative, which is like going to be the question, the test, right? And that could be where Google right now is priced for no concerns, right? So maybe we get another pullback in Google. I don't know. We'll see how this what happens, but we could get another pullback in Google because that will be the true test of now suddenly I have a platform with 800 million weekly active users who different data sources. I can't find like the exact date, but certain data sources suggest that the time usage by users in OpenAI or ChatGPT tend to be for a longer period of time. And that's also very important. Mm-hmm. And this is like a behavior that needs to be broken by Alphabet. and the demographic that uses it is very important. So if I look, I think the breakdown of like that percentage of the users that use ChatGPT, a large portion of them are American users, and they don't really break down in such granular detail the same amount for the others. But the most important market for these LLMs to advertise to is the North American market. You get the highest ARPUs by far. So it's like all well and cool if Alphabet conquers India, but and they could have like 1 billion plus users in India, but the ARPUs are going to be like 50 times less, something crazy like that. I think that's the case for Pinterest as an example. Mm-hmm. So Pinterest, growing user base, but declining ARPU. Last I checked. They're having trouble with their ARPU because the users they're struggling in North America. So
yeah, sorry, I'm like starting to crash. What are we talking about again? No. I don't know if you've ever seen that Vine. But no, the ARPU issue with Pinterest, I remember this was an issue back in like 2021. People were talking like the Pinterest bull case was like they'll grow the ARPU of the foreign base, and they never could. It's something like 6/7 of the users? No way.
No.
Yes. I fully no. I knew that. Let's play
oh my gosh! I didn't know we had so many Gen Zers.
Yeah.
I saw another comment on YouTube saying like, it's from all the Gen Z brain rot that people aren't reading anymore. It's like probably.
Man, I'm just wondering if there's anything else that smarter stock picks.
We talked about Toast versus Fiserv.
Okay.
Or like Clover or any of the PM or even Square. It's like that one's the best one there. And I think we were going to mention like within big tech, we got a lot of questions on like, hey, what do you think about Meta here? And we like Meta. So
we do.
Meta is one that, interesting history with at this point, but the fun fact is like when we went to start the fund, I actually liquidated a good portion of Meta at around the 750 mark. And so it was pretty good. And then it now just gave us like this, I think, interesting opportunity finally in a long time to add. You had the April sell-off, granted, because it got even lower. I believe it got even to like the high 400s or low 500s. But there were also other things at the time that were much better to accumulate.
Yeah.
So it was more of an opportunity cost. But then right now, on a relative basis, it's actually really attractive in comparison to what is out there as far as like the Mag 7 goes. Because I think now, like I said, or was mentioning with Alphabet, you got the switcheroo where you have, nothing will go wrong with Meta, or sorry, with Alphabet. And Meta is almost like switched in terms of its disgust and hatred. It's not getting as cheap as Google was at the its peak or its bottom, but it's getting close to that. I believe now should be trading at under a 20 times forward. And if you adjust or make an adjustment for Reality Labs as more of like a growth capex play, because again, people keep making the same mistake again and again and again and again, which is like punishing a business for its growth capex. Because it's more like experimental R&D, really. That doesn't actually reflect the true free cash flow of the business, right? The true free cash flow of the business is like what does the money, what the capital does the business need to continue?
Mm-hmm.
And then what capital is it putting to work that it thinks could pay off and grow into something in the future? So again, going back to like the Amazon example, what people keep missing with Amazon is that growth CapEx component. They're always not making that adjustment. And so they're always thinking it's expensive and then wondering why did it go up so much over this time period. It got more expensive. But yeah.
Yeah, no, yeah, and with these companies, people don't understand the difference between growth capex, maintenance capex. It's take the capex, subtract out depreciation, you have your answer for the most part. And understand that, like, I mean, especially with Amazon, they've just been doing this for years. It's just growing their empire, and I think a lot of people don't understand that's what you would want a company like this to do.
Mm-hmm.
If they can get, mid-20 ROICs or whatever they're doing, why wouldn't you want them to do it? So
Yeah, I mean, they still have plenty right now growth opportunities to invest in. We're probably going to see with like the margin expansion in retail, that story has been going. I remember in 2022 as well, when I think it was like in Sense, I pitched that exact concept.
mm-hmm.
That what's going to happen is you get ads, cloud, but then retail margin expansion starts to kick into full gear. And with them, such a high base of sales, any small percent increase there, you get massive profits to the bottom line. So we're going to see probably further automation, further margin expansion, and the profits will come. The profits will come.
For sure.
Very bullish Amazon.
I am too. We are.
Yeah, we have to. Disclosure: we're long Amazon in the fund. So, I think that's pretty much covers the big tech earnings. Aside from Microsoft, kind of just being okay, kind of priced nicely. We still don't know precise metrics for Azure at any given point in time. For some reason, they don't like to give that out. They give that out sparingly. Alphabet, the most impressive part, definitely cloud conversion rate. Still, 50% within 2 years. Backlog grew to 150 plus billion. Really bullish every single business Alphabet has. One concern is the only one that ever remains, but we'll see what happens next year. I think next year is showtime. So everyone put that on your calendar. Next year, that's the showtime. So, and it won't be immediate. I think some people are expecting it to be almost immediate. If it's immediate, I'll be shocked. I'll be like, whoa. But I expect, I think OpenAI needs it, by the way, in order so they can get more money for investment and for talent, as we're finding.
Yeah.
So,
the other one, there's actually one company that's big tech that reported that we don't normally talk about that I found interesting, which is Tesla.
yeah. Okay. We can talk about our nuanced opinion on Tesla.
Their energy storage business is growing really fast, and it's now 12% of revenues.
And what percent of profits?
I don't know if it breaks that out.
Because I would imagine the car business would overshadow them in terms of sales. And the fact that the power business is 12% is very impressive because, for example, I believe General Motors and Ford have like hundreds of billions in sales. Let me correct that. It might not be hundreds of billions, but it's outsized for their market cap. So sales figure, it's 184 billion in 2024 for Ford. And so the fact that Tesla, it's 12% is coming from energy, that tells me, as a car manufacturer, it's probably a pretty fat business.
They say gross profit. They don't. Yeah, I guess their model maybe takes the. Because do they have one where they show the margin? What's the gross margins on the cars?
What's the runway for the energy business? And we'll answer this question as well. Zstar can must have Tesla. I don't know. I'm not a lawyer. I don't know if that's like a breach of anything. Interesting question though, but I sorry, I don't know the answer to that. What's the runway for Tesla's energy business? Very large, very big.
Yeah. So to be clear, energy is not just their solar business. Tesla is. I was talking to a friend, and we were going through Tesla, and he pointed out because we were talking about possible investments in energy storage. And Tesla is the only one that has, well, they might not be the only one, but they have the largest battery sizes. I think they go up to a gigawatt. Is it a gigawatt?
Mm-hmm.
No. It was 20 megawatts. It was 20 megawatts, which is very big. So they're selling a lot on that, on the energy front. So like if you go there, they have their solar roofs and then they have their mega packs. And I think, let me see. Yeah, we unveiled our next generation industrial storage product Mega Block, a pre-engineered that integrates 4 Megapack 3s. So, yeah, 50. So, those are pretty massive. So, they're going to be needed for data centers. And, yeah, I think they'll have a lot of use case there.
And Tesla, it's been, I think it's out in the 400s again.
I don't know where it's at. I wouldn't have a clue.
Yeah, 432.
Wow. I'm not saying that, by the way, that I think that justifies the valuation. I just think it's interesting to see.
If that was a separate business, that would have probably an insane multiple attached to it. Just the energy business, and would have pretty fat runway.
It's growing 45% year on year, 3.4 billion in revs last Q. Yeah, it'd be a pretty big company.
Yeah, so yeah, at a 12 billion run rate. Yeah, if they were to keep that up, and again, whatever the margins are for Tesla in the energy business, I mean that, yeah, it'd be a pretty big company. Yes. Yeah. But yeah, like the rest of Tesla, you got it's hard to really put a value on it, but the car company, probably not the most attractive part, but you definitely have to believe in the other stuff killing it, right? You definitely have to believe the robot taxi story. You definitely have to believe the robot story at this point. You have to believe in the energy. But I think the energy is easy to believe in.
Oh yeah, I think so. It's fairly
a layup.
They have so much practice with battery technology. Yeah, I don't think it's hard at all.
Yeah, no dispute there. All right. Oh, we got a comment here. Loads of research worldwide going into batteries. There's non-zero. Tesla gets to be disrupted rather than the disruptor. Yeah. I mean, we have no position in Tesla, no interest position in Tesla. But no, I actually will save this for another time. But there's a business we like, few businesses we like in the energy space that we don't think are necessarily going to get disrupted. Or I think they're very low chance of getting disrupted, and they're the true bottleneck. And it was up a good bit today.
It was?
Oh yeah, go check it out. No, not yours, Andrew.
Oh yes.
Mine. No kidding. We don't think of it that way.
It's up, so it doesn't get attributed to you. I'm sorry.
Yeah, that's right. It's up, so I don't get credit today.
No.
We'll pass that credit along.
Garzi gets it.
Garzi gets it? Okay. Fine with that.
Awesome. Well.
Yeah. Okay. So,
crash out for bed.
It is. We went through 2 hours. We didn't get to every question or super chat. I'm not putting up Kiwi Sam super chat. And again, read there's a document in the description with the disclosures. So, again, to highlight, if you need to read the disclosures, read those. And then again, the following disclosures, any security we talk about in this live stream is representative of our opinions and our opinions alone. It's not constitute financial advice. Again, all that's in the disclosures, but to reiterate them, I also want to let you guys know that we may or may not have a long or short position in any of the stocks mentioned today. We could also change a position at any point in time following this video. So just because you're watching this at any point in the future does not mean we currently hold those views or positions in the portfolio. So yes, with that being said, did it in a sloppy way today because it is late. But we'll be seeing you guys on the next live stream, which hopefully, because I'm going to be doing this more time, that means more time for live streams, videos. I'm excited to do videos again. And too late for super chat. Oh, you want me to read the super chats, or you want to do a super chat? I can read the super chat. That's right. This one. Look away, kids. Okay. There's that one. And should I put Kiwi Sam's up, or should I refuse? You have the final say.
I wouldn't put it up.
Well, sorry, Kiwi Sam. It is too vulgar. It's too vulgar for the new standards that are in place. But we thank you for the super chat, and it was a lovely message, and appreciate your creativity in using AI.
Mm-hmm.
All right. But anyways, with that being said, thank you guys so much for joining us today. Whether you joined us on Twitter, like, retweet, however you want to interact with this video. If you're on YouTube, like, share, and subscribe. And if you're on Twitch, do what Twitch does. Do the Twitch things. All right.
We have a Twitch?
Yes, we're live on Twitch right now.
Dang.
Yeah. All right. I'll see you guys on the next one. Bye.
See ya.